a bright new light in customer engagement. And we are very honored to have Jason from Scory. So he is the Asia Pacific Regional Head of Underwriting, Claims, and Training. So let's have a welcome applause to Jason. Yeah. Thank you.
Thank you, Kenneth. Yep. Actually, I'm supposed to wait for one more co-presenter, but I don't think it's going to appear. So it's still stuck in a flight somewhere. So a quick introduction of myself, right? Oh, really?
So if you are delayed, then you didn't make it.
Right, so my name is Jason. I'm responsible for regional underwriting claims for SCOR Asia Pacific, based in Singapore. And I'm supposed to introduce another co-speaker. Actually, it's Thibault. Thibault is head of CR&D. And today, actually, we're going to talk on a topic known as biological age model. And this model actually is an evidence-based approach to using the parameters of physical activity to risk profile an individual and make adjustment in the premium as the data comes in. So in terms of approach, it is a step towards dynamic risk profiling, or we call it dynamic underwriting. And we think it's a game changer because compare that to a traditional underwriting, which is done a static single one point. This will give more insights and make more sense. Right, so before we go into the technicality of BAM, I want to draw some insights from recent publication and survey. And the first one from the Institute and Faculty of Actuaries, published in September 2017. We know globally there's going to be big influx of data. And how much data? Measured in 2015, no less than 2.5 exabyte per day. And how much is 2.5 exabyte? 2,500 billion bytes. Okay, still doesn't ring a bell because it doesn't make any logical sense to us, right? How about this? 90% of total data in existence, measured in 2015, were all collected over the last 2 years. So assuming if you're willing to share the data to the insurers, how do you expect the industry to evolve or change? It's not difficult to imagine. Put yourself as the individual willing to share the data with the insurer. How do you expect that insurers to make the change, to engage you and to improve on the product features? So if I put myself as an individual looking to share the data with the insurers, how would that go? 3 points I think I would expect insurers to do. First, a more individualized risk profiling and less subsidization of people who are less healthy, and more accurate way of managing risk, real time is possible. Secondly, every contact with me as an individual to be more meaningful, sharing feedback on my lifestyle, sharing feedback how I can improve my risk as compared in the portfolio. And thirdly, from a claim perspective, no longer just improving efficiency of paying claims. I want the insurers to be able to help me prevent the claim, shifting the focus away from reactive care to preventive care. So then the insurers become a partner with me, ensuring that we are both guarding against the event to happen. So this is the 3 things I expect the insurer to do. And where do you think we are at this point? Are we ready to provide these services to the client? I think there's a gap here, but let's see if BAM is able to bridge the gap. Okay. As the industry innovates, how do you think the insurers are being seen by the insured? How the customer looks at the insurers? I think in terms of relationship, both insurers and insured sits on different end of the spectrum. We get a lot of these comments from the insured when we did our survey. The insurers ask me a lot of personal questions. I do not know why is it used for and how is it going to impact me. And at the same time, it seems like the more information I share, I'm going to get penalized. So clearly there's a missing motivation here to share the data, right? So if I look at this, it looks like there's a gap of interrelationship between the insurers and the insured. How can we improve this relationship? This is something I want to look at in the discussion later. And if I can pinpoint these 3 pain points of traditional underwriting, that may change the relationship. First, a tedious, invasive underwriting approach. The application form completion, the biometric screening is just too tedious. Can we improve on that? Secondly, the one-size-fits-all premium don't really make sense. If you and me of same gender, same age, and non-smoker, when we join the portfolio, we pay the same premium. And thereafter, the premium is the same. If you live your life more responsibly, you exercise, you take good care of yourself, and I party, I drink, and I don't exercise, we pay the same premium. So does the model make sense to you? And there's the absence of engagement. The minute we join the portfolio, the next time the insurers contact us will be, or rather we contact the insurers with the time we make a claim. So an average life policy of 25 to 40 years, there is no engagement between insurers and insured. Does it make sense to you? So I think if we want to make changes in terms of the processes, these are the three key pain points that we can look at to improve. And let's draw some insights from the Global Consumer Survey done by Remark and the MuleSoft CCI survey. We talk about customers are reluctant to share data. Why? Because lack of privacy. Clearly, if you put yourself as an individual, I would want to tell the insurer too much because first, they're not going to give me a discount anyway. And in terms of channels, individuals are more willing to share information online via a portal than to talk to an individual, a person over the phone or face-to-face. But if you look at this, customers are reluctant to share personal data, or are they not motivated to share data? That's the difference here. So under the CCI MuleSoft survey, it's proven that 44% of the consumer are actually willing to share the data if you can put in some form of motivation there. So if you put in premium discount, I don't like the word discount, actually better to say premium adjustment based on the risk profile of the individual. The customer are willing to share information with us. And this is third-party information. And these are where the interviewees were based in terms of geographic breakdown. So I think if we put in the right motivation, consumers are willing to share information with the insurer. Okay? And in terms of data, some form of information are more shareable. Taking insights from this survey, looks like on the spectrum here, clients are more willing to share this data, and these are all lifestyle data pertaining to your diet, pertaining to your exercise regime, and height and weight, versus very personalized data like sexually transmitted disease or occupation-related disease. So if we can find alternative proxy to risk or mortality pertaining more on this spectrum, it may not be a bad idea to use it to risk profile an individual. So let's see if we can potentially use information here to measure the mortality risk of individual. Okay. And next two slides will provide good news for the insurers. The wearable ownership is on the rise. And what does this tell us? Individuals are concerned about their own health, and they are leveraging on wearables to find out more how they are improving in terms of health. So for example, if for myself, I'm aspiring Ironman, going to do my full Ironman potentially. So I will use the wearable to find out my resting heart rate. If I'm good to continue training today, I'll find out my VO2 max, if I could push my training and improve my fitness. I'll use it to pace my race itself. But for the layman on the street, the wearable provides the level of activity the person is doing, the number of steps, how much time is spent in the exercise regime, and what's intensity. So this is good news because at least it shows that the individual are concerned about their life and their health, and they are leveraging on the technology to take that forward. At the same time, we realize health is a new wealth here, and individuals are spending money in terms of wellness program and fitness gym to improve. So this is a good opportunity for insurers to engage the insured, right? So health is a new wealth, and if you leverage on the wellness technology, you can engage the insured to live their life better. So with all this insight in mind, we actually started thinking about how we can reinvent underwriting, and that brought us to BAM, and I will show more detail into BAM itself. Okay. So BAM stands for Biological Age Model, and it's actually a step towards dynamic risk profiling, or we call it dynamic underwriting. So with the strategic partnership with Viva Metrico, a company in Canada, we got access to a database that we are able to follow a group of 18,000 individuals over 20 years. Can you imagine anyone who thought about collecting physical activity data 20 years ago? There is no Garmin, there's no Fitbit. We call that pedometer. Okay? So this individual, they provided not just the physical activity measures in terms of steps and minutes of activity, they also provided their biometric screening result. And of course, there are demographic information as well. So the first insight that we draw from a study was physical activity is a good predictor of mortality. As a matter of fact, I don't think we need to go too much into this. Several of the medical journals already proven that exercises actually helps you to predict the mortality risk better. So with this, we could actually, first insight that we draw from the data was the minutes of activity and the number of steps. The more you exercise, the better your survival rate, as you can see here on the top here. And since we collected both biometric result and the physical activity, we were able to measure the accuracy of prediction by each of the indicator. And looking at this slide here, we realized the wearables variables, daily steps and daily activity, was able to predict mortality risk equally well, if not better, than the classical underwriting variables, which is BMI, blood pressure, waist size, cholesterol, and smoking. And using this, we're able to derive an algorithm that help us to make a prediction of 10 years mortality risk of an individual. We draw a 7 days activity data on that person. And it's going to be periodic. Every 7 days, if you can collect the data, it helps us to move the prediction forward. So if you look at the curve here, the more steps the person takes in mortality risk actually drops. Beyond 6,000 steps, the risk actually flatten out. Okay? I'm trying to make it more technical, but this part is covered by Thibaut, but since he's not here, I'm going to go through this. Yeah. So with this in mind as well, we try to see how we can apply the dynamic engagement, which is continuously. We all understand what we meant by standard underwriting effect, which usually wear off within 3 years after the engagement. If you can duplicate this engagement continuously or periodically, you'll be able to keep this person on the preferred risk curve. And even if you drop off, you're still in the sub-preferred risk. So we're looking at a model that enables the person to share data with us, and we keep this person engaged continuously. Okay? And face it, sometimes to exercise, you really need someone to push you to go further. So far we talked about a tracker program which measures mortality risk. So where does the biological age model comes in? We realize by using biological age, it connects to the individual better. So if you look at a tracker program, it tells you this week you have $5 discount, or next week $7. After a while, you lose this person. If you tell this person, because of exercise of 10,000 steps per week, per day, per week, and your biological age is actually 25 instead of 30, it connects to the person quite immediately, seeing that, well, okay, because of my exercise, my biological age is actually lower, and I'll be priced based on that age. So that connects to the individual and motivate the person to exercise more. So the BAM model works on physical activity as a basis to risk profile individual, and we adjust the premium accordingly. And we think this is a beginning because we're using physical activity. There are other parameters that we can potentially use to bring this forward, right? And this is something, a vision that we're looking at. So BAM looks at physical activity and lifestyle data. How about medical data? If someone's willing to share their health screening annually with you, will you be able to risk profile the individual better? Potentially. how about the location, social economic data? At this point, your handphone is able to give you, or rather, if someone collects mobile data, we will be able to know where you were and how you were living your life. It acts the contextual awareness to you in terms of risk profile. So we can use that as well to adjust your risk on a daily basis. And of course, genomic. The genomics data provides insights to your risk awareness. How can you prevent the risk from happening if you put that into your lifestyle application? So this is something we're looking at, but it's really going to be a long vision going forward. Potentially, we can come up with a dynamic risk scoring that can follow an individual on a daily basis as they move on. So this is something we look to develop and work with interested party in the market. Next, I just want to cover BAM with a preliminary result that we have collected from a project we launched somewhere. I can't give the name away, and showcase how BAM has been marketed. Right? When we talk about BAM, it looks like it's just an engine driving the premium adjustment for the individual when they join the portfolio. But actually, from an individual point of view, we use the lifestyle risk as a holistic wellness platform back to the individual. If you share your data in terms of your diet, your sleep pattern, your stress management, and your alcohol intake, this platform will provide the feedback to you and how you can improve your risk using the platform. So BAM itself is just the engine. How we market this to the individual, we leverage on the wellness platform. And that can be created with other other marketing gimmick using free device and using a wellness app as well. Okay. This is an explanation how it actually works. If someone's biological age is actually lower because more exercise, we will give a discount. But if someone's age is higher, we do not penalize the person. As a matter of fact, if there is no discount, it's a form of penalty already. So, and this person comes back to exercise, you get back your discount immediately. So this is how it works as a basis to encourage people to share the data with us. Okay. And preliminary finding on one of the projects we roll out. In this cohort, about 2,000 live, we asked for individual to bring your own devices, like Garmin or your Fitbits, to join the program. So we split the incentive into X amount and 4X, and we realized that through the cohort, there were different consumer behavior that was coming forth. So one of them is incentive clearly changed the behavior. The guys on a 4X incentive clearly sits or stays in the motivation mode longer. And the engagement does drop quite quickly. We need strategy to keep these guys in place, especially the guys who are younger. So the holistic wellness approach is necessary to keep these guys intact. The younger guys, we need to find out why did they join the wellness program? What are their goals? Do they want to lose weight? Do they want to improve their energy? Or do they want to get fitter? So the whole wellness approach helps to keep this group in place. And because this is a bring your own device program, there is a strong selection effect in the program. So those guys who are engaged tend to be healthier, and they are clocking average of 8 to 10,000 steps a day, and that's very high comparing to other markets in Asia. Okay. And we found out that the women were fitter in this group. It's okay, not to say that women shouldn't be fitter, but we think it's because the females' premium rate is actually lower. When we try to calculate the biological age improvement, their improvement tend to be higher. So in this cohort, 60% of the individual we have received better biological age, right? And 5% didn't get any improvement, and the other 35 still unengaged. So we are still collecting data on this group of people, and with more projects implemented, We're going to see how it's going to be like, and we will share the data later. All right, so pretty fast. That's actually my last slide. So in the forthcoming data-driven industry, I think there's a role where insurers can play, which is to engage the individual more, use the empowerment of understanding of their lifestyle as a basis, and I think it was potentially possible to create a win-win situation for both insurers and insured. Okay, I think that's my last slide. I'm open to questions.
Thanks. You talked a lot about the upsides for the healthy people. For this to work, the unhealthy people have to pay more. You can't floor it at your standard rate. So how does it work when you start having a breakdown in the pooling across similar lives?
Yeah, well, I had a lot of that debate with the pricing guys every day. So if you want guys to share the data with you, you cannot penalize guys who are less healthy. So the improve in persistency and the improve in mortality will help to allow us to price it down. But the exact engine, the exact how we do it, I'm not too sure if I can tell you this here. But come to the booth later, maybe we can share more information. But our approach is to ensure that we do not penalize people who are less fit. As a matter of fact, we want to engage them to bring them forward and share this insight with them. Does that help?
Have you put this pricing practice into use yet with your clients?
Yeah,
that's the first question. The second question is, given that more than a third of the people are not engaged at all, what can you or the people who are involved in a program, how can you increase the level of engagement in those who are not engaged at all? Thanks.
Yeah. So first on the engagement part, this project has already been launched, but it's under implementation stage. We have about 4 projects in the pipelines. So the first one, potentially, you will see it somewhere in Asia. I can't reveal the names now. Mid-October, there'll be a first project. So we use that basis to start collecting data. And on the question on how do we ensure individual will be motivated to get going. So the discount we promise is up to 30%. So it's quite, of course, that I don't expect a large group of people to qualify. And potentially half of them will at least qualify for 5 to 10% at least. So we use that basis to start people going. And the lifestyle, like I mentioned earlier, the holistic wellness platform, to keep them in the engagement mode. So hopefully that will get them going and get they stay on the platform itself.
Thank you, Jason. It was a really good talk. I guess my question is why do we think that policyholders want to be that engaged with their insurance companies? And why do we have that assumption? And then secondly, if we do have the customers with these multiple touch points to the insurer besides just at purchase and at claim, what does that mean for the expenses of the insurance company and for the staffing levels?
Okay, so on the first bit, why wouldn't you want to engage your insurers? And if you buy insurance policy, would you just want a peace of mind that they pay out a lump sum to you at the end of your lifespan? I think there'll be more meaningful approach here if you put the insurers as the partner who help to prevent the risk from going. I think the prevention part is really missing in the whole engagement tool here. So the idea here is to empower the individual. If they want to engage the insurers, they can. And they will change the ballgame than to not do anything at all. I think the focus now in this current moment is to place that on individual. And they can decide what they want to do after you share this with them. I think this is the first step the insurer should take to go forward. Yeah. On your second question, which is the expense, is that correct? How do we manage the expense aspect? Okay, because this is an evidence-based approach. So if you take 10,000 steps per week, per day, we will know roughly what is that amount in terms of present value of future mortality gain. So if that is $10, we can give you back $8 in terms of motivation. We keep the $2 to help work on the platform. So I think that will help us to manage. Then to use it on marketing-based program. I think there are a lot of program that's running in the market now that's based on marketing expense. They're used to acquire client using a marketing expense. We're not going that approach. We're using this evidence-based approach to make sure that there is a value in improving our health before we pass the motivation, the discount back to an individual. And that discount is periodic. If you stop sharing your data, the discount ends. So it's not like, oh, you qualify for a discount and that on is all forever. So every 7 days, it changes. So you have to continuously share the data and stay engaged to exercise, and this discount will continue. So I think expense-wise, I am not worried about that.
Okay, we have a question on this side.
Thanks, Jason. I have a question about, two questions. Firstly, can you talk a bit more about the data? What country they're from, what's the profile of those people? And secondly, when you develop your algorithm, how do you separate from cause and effect? For example, how do you, rank, the risk factors? Is it age, daily steps, or gender? I saw you had a slide on the ranking. Someone's more active, it just means that they're young. Doesn't mean they're healthier. So can you talk a bit about your approach? Thank you.
Yeah, well, actually we have more slides on the technical end, but my background is underwriting. I couldn't really bridge the understanding across, but I understand what you're talking about. We have a slide to talk about the different indicator and whether the result we gotten from the study, is it based because these guys are younger? So the background of the database is they are US based. Okay, there isn't any other database that provide this data at this point, at least. So we work with this first. If you can derive the algorithm, we're hoping that we start collecting local data, and that will help us refine the algorithm as we move. So that's the basis as we go forward. But I'm trying to see how I can understand the bit on, there is a improved effect of exercise, and is it because these guys were all younger, right? We have a slide there, but Stefan, you want to help me out for this? Yeah.
My name is Stefan König. I work in the Critical Illness R&D Center, and I work in the team that was working on the mathematics behind this. But I'm not the guy in the team who worked on the mathematics on this. So this is my boss, who is still in the plane, or actually right now he's in the tram from the airport here. So he didn't make it on time. But when you were asking about this slide, so a little bit background I have on this. So when you saw the slide, can you put it on? The one with that was actually the result. What we did on the database, we applied a bunch of machine learning algorithms and a lot of the final algorithm was a random forest algorithm, and what you see on this slide is actually the predictive power of the different variables. So, and of course, age is still the one with the highest predictive power. That's why it's ranked as a top. So, but you can also see that the lifestyle variable, in particular the steps, were ranked very high at the top also. And in fact, it was actually ranked higher as gender. So we can see, if you compare these two variables, that physical activity is more important as male or female. And as actors, we know that male, female is the one thing we always priced in, except in the European Union, where we are not allowed to do it anymore. But so then, no, I didn't mean this, I mean the one with the, this one. So here you can see that the daily steps, where's the light? The daily steps are actually above of the gender. So, and I think that was what your question was about. So this is not input, this is really output of the machine learning algorithm about the predictive power.
Maybe just a quick follow-up on that. I presume your data is from US, and in Asia, obviously we have not much of data to do this kind of analysis. I just want to understand better from pricing perspective, like how do we overcome the challenges of getting the data or accumulate the data? Thank you.
Yeah, I think that's always a first leap of faith towards a point where there's no data. So we use the algorithm first to see how we can start collecting data, and with a smaller projects to enable the data to refine the algorithm as we go. So we're not going to allow no data to stop us from moving forward. So I think that's the engagement we are trying to build here to take this forward. Yeah.
Thank you.
My question has to do with the business side of the model. I'm not sure I understood correctly, so you can clarify. If somebody comes in and perhaps has no discount when they start, the second year's premium, if they are more fit, they get a discount?
Yep.
What happens then if they regress and get back to their original shape? Does your model increase the premium back or not at all? So in other words, it keeps ratcheting down, never comes back.
So the model goes this way. You never pay more than your traditional premium as it goes. So that's the ceiling that you will go, but it can go further down up to the maximum discount that we are willing to offer. Yeah, so the maximum part is the premium based on your age that you purchase the traditional model when at your age that you buy. That's how we price it. But if you get better, there is a discount that goes monthly. If you get worse, that's a maximum as well. You will not go beyond. Yeah, the maximum is traditional premium that you pay here.
Okay, next question at the back.
How much time do we have? Oh, 3 minutes, okay.
Okay, hello. So I'm interested in knowing a bit about the data. And then I assume that for this US data, it is not an insured data?
No,
and
it's not.
Yeah, and then in this case, because I would expect that for general population, the difference between a healthy and unhealthy population would be bigger than an insured population because of the underwriting. How do you guys factor that in when it comes to the BAM? Did you guys normalize anything regarding the underwriting effects that would be normally expected for insured population? Thank you.
Okay, Thibaut, Stefan, this question is for you.
Already had some health issues, so we could censor the data, pick all the people out that we would assume to be non-insurable or not fitting to our model, and run the real machine learning algorithm on the sensor data that we assume reflects an insured population.
So I think if you have more questions, come to the booth. I think we have more able people who can answer those technical ones. I mean, I'm from underwriting background, and I think the purpose here today is to bridge the gap with the actuaries. I somehow represent the underwriting guys, and we want to see how we can take this dynamic underwriting concept further. There's a lot of potential in this concept, and yeah, we should work together, I think.
Okay, thank you, Jason, and thanks for the good sharing. Let's give a round of applause to him. Okay, on behalf of the organizing committee of AAC, I would like to present a souvenir to you. Thank you. And thank you, everyone. So our next session will start at 2:45. Yeah. Thank you. glad to have representative from Moody's Analytics to have some sharing. So we will have Andrew Waters, the Senior Director, and Shah Choi, the Director from Moody Analytics, to do some sharing. Yeah. So let's welcome them. Thank you.
Okay, so thank you for turning out. I promised to give the most interesting talk on model governance at this conference. It's also the only one, but joking aside, I did submit 2 topics, and I'm very pleased to be accepted on this topic because it's extremely important, but a vastly underrated issue within actuarial modeling. So I'm going to get going. This is who's speaking today. I'm joined by my colleague. We're going to talk about the overview, kind of give you the background basics on model governance, model risk, model validation, et cetera. And then spend some time talking about how that's evolving. But I think the bulk of what is going to be interesting on the presentation is how technology is involved in assisting with model governance. Okay, and that actually works both ways. If you don't have good technology in place, you can have poor model governance. Before we get started, I'm going to do a polling question, and I think the best way of doing this is a show of hands. I don't think we have the technology to do this, but a show of hands still works. Everyone's got both arms that'll operate. But I want to get an idea of whether your organization is managing model risk very seriously. They know that this is something that is constantly evolving and has to be paid attention to. So that's section A. Show of hands. All right. Yeah. Okay. Good. All right. And B, the normal actuarial process that's been in place for ages is sufficient. There's no need for real improvement. Any hands? No, of course not. And anyone who's learning about model risk management for the first time? No. Okay. So I know what. Oh, okay. We got one. All right.
My hand up, I as well.
Oh well. I think there's room for improvement for all of us, and I hope that we'll be able to educate you in some way today. So just looking at the drivers for model risk management, it wasn't led by the actuarial industry. I hope that's not a surprise for anyone, and I hope it's not insulting either. But actuaries have been described to me as cowboys. I know that's not a common reference, but the context in which that was given was for modeling, they love just tinkering with models and changing them and making every little tweak and just fiddling with it so they make it a perfect model. That's the goal anyways. But through all that agile development and creation of models, what's happening is you're creating a load of risk along the way because there's not a lot of structure and control and discipline around that. So when we think about some of the things that did drive this initially, we're thinking more about management and boards. Okay, we think back to the global financial crisis. We can easily imagine that pricing of CDOs or CMOs would cause some issues, and that got the attention of management and boards. So those stakeholders are definitely in play here. Then you think of the regulatory requirements to report on governance policies and practices. So we go to maybe internal models for Solvency II, for example. Some early regulatory guidance on model governance came from the Fed, actually. So if we think about the non-bank SIFIs, so Peru, MetLife, and AIG, they were all being overseen by the Fed, and the thing that they required was prerequisite that they have an examination of the use of the model included in their submissions. Okay, but then we do get, of course, the actuarial profession and the standards of practice. We'll spend a bit of time talking about those. It's a work in progress, I would say. The adoption of these sometimes a bit slow. The finalization of those standards is fraught with debate, and it is increasing in its visibility, however. Okay, especially in North America, we've seen a lot of newsletters and the meetings that the SOA would hold having prominence of this topic, so much so that new roles are emerging within these companies. Okay, so over the last 5 years, we see a vast increase in that as a key topic. So when we talk about the progress globally on the actuarial standards of practice, they vary, of course. And I'm going to just give you a few examples here. So the US, the Actuarial Standards Board, really, they began looking at the standards of practice for third-party models through the Academy of Actuaries. And, that began in 2010. But the modeling, this modeling standard is still not finalized. Okay, and the reason for that is what I was referring to earlier, is this industry debate. Okay, so when you try and set industry guidelines for generic industry guideline to cover all the practices, it becomes very difficult to have a single guideline. So that's where there's a lot of issues that are coming about. Also in the US, you have VM20, so principles-based valuation, which relies heavily on the models, and it also has guidance and documents that are provided around standards of actual practice, but these are not binding standards. Okay, then if we go to Canada for a second, so I'm Canadian, hello, any Canadians out there? But these are binding standards. So since 2011, they've been looking at these and investigating and debating these standards, and they're both general and specific to practice areas. So this is a slightly different approach than the US. So we have new definitions, and specifically referencing the building of models, a little less prescriptive on the use of models. Okay, so some subtleties there. Then the IAA, so we heard earlier from Yoshimura, the president of the IAA, talking about ISAP 4, so that's in relation to IFRS 17, but we also have the 1A on model governance and 5 on models, and these international standards of actuarial practice are not specific to the actuaries themselves, but the membership bodies that are part of the IAA. So they need to consider these in setting up their own guidelines for their individual jurisdictions. Okay, so then we have the Financial Reporting Council in the UK. So this is actually, I guess, one of relatively old, so 2010 that became effective. One of the key principles of that standard is that the model needs to be fit for purpose. Okay, this is probably a very useful term that we should keep in mind in relation to models. Okay, so just really briefly here, we're talking about how a model represents a complex system, okay, and it provides useful info. So that is paired with risk, which is highlighting that there are flaws and limitations to models, or its use that can provide inaccurate or inappropriate conclusions. So back to the old adage of models are of course always wrong, but they can sometimes be useful. All right, so we keep that in mind. And when we go to the key components of what model risk management entails, we're talking about the day-to-day activities, the operational activities involved in the development, the creation, development, adaptation, enhancement, use of the models over the lifetime of this model. Okay, and in doing so, we have an inventory which tracks, of course, the usage of all models within the organization, their significance, any of their limitations, the current status, etc. Validation, obviously an extremely important segment of model risk management. This is an area which, actuaries play a very key role, of course. The people that have to validate the models are the ones that know and use those models. All right? Now, they need to be guided by the risk management principles of their organizations, of course, so that they're not marking their own homework. But this is kind of the key aspect of whether a model is valid or not, which brings us to governance. Okay, so model validation is not governance. Governance is about the usage, right? So you could have a totally appropriate model being misused, and this would then have, of course, knock-on effects, which would be negative, potentially. So let's talk a little bit about the practical considerations. Okay, so if we think about people at the heart of all of our businesses, we can obviously see that there's a variety of roles involved in modeling. And one of those roles that I was actually referring to a bit earlier was this emerging roles in relation to model risk management. Not sure if any model stewards exist in the audience today. I assume not. This is not a common role that we see out in APAC. But in North America, this is, over the last 3-4 years, you see this specific role for the effective management of models within these organizations. So they're the facilitators of this process. Okay, so this is requiring the appropriate accessibility and permissions, and now you can start seeing how technology is going to creep in and start playing a role in this. Okay, because we need to have those controls, and also execution and sign-off being very critical to the tracking of their usage. The processes, of course, this is essential to make sure they're being used correctly, and we want to reduce the risk within the model-related activity by having compliance monitoring, et cetera. So again, technology coming into play. I think data probably is the most important element of models, right? You're feeding data into these models. If you're feeding it with poor data, of course, you're going to get inaccurate or unreliable results. And I guess when we think of insurers, they're collecting and storing vast amounts of data. It's only increasing. And that could be policyholder data, which is confidential. We could talk about market data, product information, et cetera. And all of this is to support actuarial analysis. So experience analysis, the modeling, valuation, pricing, et cetera, financial reporting. And the inputs to these models is quite critical in making decisions. So that's why it's so important. But how often is this data or the results that are being produced misused, misinterpreted, miscommunicated, or simply incorrectly modified? Okay, I would argue this happens quite a bit, even if it's just by human error. Assumptions, I guess you might consider assumptions a subset of actuarial data. And again, we're thinking more now today about the changing of assumptions and how those are tracked. If you think about IFRS 17 as an example, it's very important to have that tracking over time, and how those assumptions get stored and used, very critical. The last point is on model configuration. Okay, so the configuration of the model is data itself, I suppose. The parameterization of the model, the structure of that, and how those parameters support the calculations, and then the extraction of the results from those models for reporting purposes. Okay, so I may have already kind of covered this in some of my earlier comments, but it is a framework that is set to provide guidelines to ensure that models are being used effectively and that they're managed on an ongoing basis. Okay, and this is through the life cycle, not just at the inception of the model, but throughout the life cycle, and that we're confirming that this is a quality model that's fit for the purpose. That's an ongoing check. Okay. Okay, so when we think a bit about going, I guess, beyond model risk, we also want to think of the inherent weaknesses in the models. Okay, how flexible is a model This is a really key element for people. They want to be able to use it in a variety of circumstances, but we also have to ensure that we do so in a structured way. And the usefulness of a model also goes into this definition of how is it going to be applied? Is it being applied appropriately and consistently across the organization? And then we get into this model efficiency point, and we talk about how quickly can we use it and produce results. Okay, how much resource does it take, both from a technical and human resource perspective? Right, these are key criteria as well. And then the costs associated with that. Okay, so how much hardware do we have to use on a regular basis? How much people usage do we have to have as well? The time that we use to tinker with our models, change them, lock them down, all that process takes time and is an overhead to the process. And then this point about consistency, the larger the organization, the more important this becomes. If you want to have alignment of models across the organization, you'll have a better way of comparing the performance of each business. Okay. So there's the IAA has this risk book. It's actually freely available. There's a chapter on governance in this. One of our colleagues is co-authors, Trevor Howes. And this is a good reference for people to look at. I highly recommend you do. There's actually an update on that risk book that's happening very soon. Okay. When we think, so I'm just going to give a few examples from the Actuarial Standards of Practice from Canada, because they made some changes to the definitions as a result of IFRS 17. Right, so this is another trend we can expect to come elsewhere in this region. Okay, because we have a significant complexity of actuarial models, we need to look at the importance of the model. So what's the significance of it, and make sure that the effort in managing that model reflects the complexity. All right. And they also reference the ability to control models through detection and preventative approaches, and the validation effort also is going to be aligned or reflective of the financial significance and complexity of the model. Okay, so these are all good guidelines, and maybe something that will be coming here to Asia. So just kind of in reference to where some of this came from, so there's this exposure draft that came in May 2018, and it was driven by the IAA's ISAP 4, okay? But there's still questions of whether this is appropriately reflecting the role of the appointed actuary in IFRS 17 reporting. What is the degree of sign-off importance that is going to be attributed to this is, I guess, remains to be seen. Okay, so at this point, I'm actually going to pass over to Shar. She'll take us through our next polling question.
Hi, everyone. Question, the polling question. A formal framework is already in place with clear policies outlining processes, roles, and responsibility, and there's only minor improvements required for maintenance purposes. Is that how you would describe your current company's model governance? Could you have a show of hands, please? Okay, good. So we have about half dozen. So, second one, there is a framework in place, but there's definitely room for improvement. How many of you would think that your organization fall into that category? Okay, good. So we have a little bit, about a third. And the next one, significant improvements to existing practices are needed to activate robust model risk management framework. How many would you think your organization in that category? Okay, I see none. Okay, that's good. That means people are aware of it. Last year, I attended one of SOA's seminar. the topic was model risk management. And guess what? That webinar, it was one of the most attended webinar in the SOA. And SOA put out at least like probably twice a month or even more webinars. And that one was the most participated and most interestingly, and that was most debated at the end of the Q&A. Okay, and how often you see actually passionate about something. They had some heated debate about what do they think the model risk management should be practiced and who should regulate them. Okay. What I want to talk about, my session is talk about the technology considerations. I started my career about almost 30 years ago. 30 years ago when actuaries do modelings, a lot of them, the model governance is really depending on the modeler, their own self-discipline or and their awareness about their professional consciousness because they know the model will be passed on to someone else. Okay, and everything is informal. But then now, in recent years, things change a lot. Why? Because a lot of a model mismanaged actually ends up in the courtroom. Okay, this is like it's commonly in the US for a while. And the reason of being is that during the M&A transaction, so company A, usually a consulting firm A, stated the appraisal value. And then by the time that the transaction went through, but when the company, the buyer took over the business, what they find is that there's so many error in the model and materially change their appraisal value. So in order to resolve that, it ends up in court. And that's why you see in 2016, a lot of regulation came out of the US, and that is the reason. So in one of my previous jobs, I was working for a consulting firm. Right now in the US, for any M&A reports, it is required for an actuary to have 3 disclosures. One is your data quality, where your data come from, okay, and who you rely on. Because for a consulting firm, a lot of time they rely the data on the company, on the insurance company, okay. And then the next one is model. Like what's your, based on what model, or the quality of the model, the use of a model, and is the models being used appropriately for the original purpose of the model built? If the purpose you use is different than your model build, then you have to state what kind of considerations, adjustments, and you have to justify that's appropriate, that it's appropriate actuarial judgments being applied before you form the opinions of your model. So typically a consulting firm goes in there, they use someone else's model. Okay, so they have to place reliances on a third party. So when you end up in court, it's very clear in your actuarial opinion who's responsible for error in data, who's responsible for error in assumption, and who's responsible for error in the model. Okay, so that's why it's so important that it becomes such an important issue, especially last year, US started with PBR, principle-based reserving. All of a sudden, the whole entire industry switching from a formula-based valuation method to a principle-based. Okay, and like Andrew mentioned earlier, the VM20 is the IFRS version of TVOG, the time value of guarantee. So requires stochastic modeling. So the requirement for actuarial model, all of a sudden, it went up tenfold. Okay, because some of you probably know the US original valuation method is based on lock-in assumption. So you have policy issued 30 years ago, you don't update it. So chances are you're not going to be wrong. And it's a formula base. But now, everything on the seriatim level, everything, the assumptions has to be current, and the requirement is stochastic. So that's why the model governance all of a sudden bring up to the forefront of the profession. So what is the implication of technology? You know, someone made a joke. It says, now the software and the model runs so fast, you can make mistakes so much faster. Okay, so, and the products valuation methods become so much more complicated compared to 40 years ago. And that requires a lot more technology. When the technology becomes more complex, that just means there's more room for error. Okay, but then what we believe is that also technology can help you to control model risk. Okay, a typical actuarial model as an enterprise application. One thing, probably some, you know, the APAC clients can share the same. Actuarial model control process is more IT-like. Okay, none of your actuarial cowboys and running your stuff on your own at the time of your leisure and change things on your, you know, as you like. But now it's a lot becoming more process-driven and IT control. So basically, for your enterprise application of actuarial model, you will have input, actuarial model engine, and the model results. So those are the solutions created by technology, and also in terms of model governance, and also can be contributed by the technology. And let's go through that. So typically, an actual model engine has your model design, you have a codes, your compilers, and the interface. So the sum is the engine and plus configuration of the data assumptions. And nowadays, in all the in the market, all the actual models can probably fit into a spectrum of the scale. On your left is fully user coded, so you basically like Excel spreadsheet. You open it, you code everything. On the other extreme is fully closed coded. So the source code of the commercial actuarial model, actuarial system is not to be touched by the user. And anything else in between, you can probably think of it, all the actuarial applications fit in there somewhere in between. Okay, what's the difference? Your fully coded will have a specific, your fully coded with user codes require specifics of model logics and coding logics in the software, and plus you have to do the compiling and debugging. Okay, the vendor code models would require loading the business data, the definition of assumptions, and the model configuration. So, as you know, more is being done by individual and by manual process, and more chance you have error. Okay, so, and that's why in recent year, the vendor coded system become much more in demand, because they find that they would outsource the coding to the vendor, reduce the actuarial efforts in coding. So the idea is that you liberate the actuaries from coding and let the actuaries do the actuary is supposed to train to do, which is analysis. Okay, so with the technology, in your actual system, it either is homemade or vendor supply. There's two category of model governance tools that you can apply. One, obviously, is preventative. Another one is deductive. So by the definition, it's pretty easy to think, to understand. Preventative is that you build in the logic in each checkpoint and each end of a sub-process. You enforce control, so you can prevent error from happening. For example, if you building an asset portfolio, you have a portfolio return of 400%. That's obvious an error, right? And if your data, you come in there, you vet your data. Instead of issue year 2013, you have 3013. That's an obvious error, and that's an error that can be prevented. And the other category will be a detective techniques and tools that you can build in. And that's where, in your model, you set up a control and process, you apply a tool to review your results and find where it's vulnerable to produce model error, okay? And again, to have a very good actuarial modeling process for the model governance, the key is discipline, okay? You have to be disciplined in your model development, and your discipline in your production environment, and your discipline in your proving process. Good softwares should provide tools and utilities for that. And what we have here is that actual models right now typically build in, who's allowed to go into the in the production environment, who's authorized to sign off the results, and who's authorized to pass on the results to the external department like finance. Okay, so that has to be very disciplined. And how you code your model, it's also vital. And how do you validate your model, it's also vital. And one thing that we will, promulgate is model transparency. And transparency seems very obvious, but when it comes to actual model, it should be applied in a very disciplined way. Transparency, meaning that the company's model governance would have clear, defined requirements. How do you document a model? And what is your change process? Okay, does your company has formal change process for every time that a model is being changed for your production? And then, and also model results review. Another, one more thing is that, we want to talk about here is avoid choosing or define assumptions within the codes. Those are the disciplines when you build a model, okay? That means that, you don't ever hard code anything for a variable and when it should be updated. And a use object to can take assumptions that can be checked and reviewed easily. Here we talk about technology can enable model governance. So again, in your actual models, you should develop tools that standard procedures and how you govern the model risk. Moving the model off desktop and move towards a centralized infrastructure area right now is the most popular, the most, I think, suggested approach, like on the cloud, on your server, instead of your individual PCs, and a lot of time for backup reasons, and also for reviewing, for reviewing reasons. And also standard tools when you build a model to test a block of business and test them repeatedly. And every time when you make any changes. The next one is we talk about automated attribution analysis. When you apply automated attribution analysis, actually that's an easy way to find any model errors that you may have. So regression tests, and that's something that's very important. So when you do make model changes, okay, the regression test is that testing the part, the results not supposed to change, is that been changed. And that's something a lot of new modelers would overlook. In the interest of time, I just want to summarize. Effective model documents, it's part of a good model governance, and also effective hardware environments is very important. And lastly, process. Do you have a good process in your area, in the company? And disciplines. And again, doesn't matter how good the technology is, it's the people that applies it. Each one of a modeler, when they're handling the model, their professional integrity, their disciplines come into play. Thank you very much.
Thank you, Andrew Shah. So in the interest of time, maybe we can allow one question, see if there's any questions from the floor. Okay, seems you understand a lot. So thank you, everyone. So now I would like to, on behalf of the organizing committee, I will present a souvenir to Andrew and Shah. Yeah. Thank you very much. Yeah. Okay, thank you. So I was told I actually got a souvenir because I'm a moderator. So Gary will present me. So thanks everyone joining this session. So it's a coffee break time. Yep, enjoy.